This podcast is produced by qualified financial professionals and is intended to share general information and insights to help expats better understand common financial topics. However, everyone's circumstances are different and regulations can vary by country, so nothing discussed should be taken as personal financial, tax, or investment advice. If you're considering making financial decisions based on anything covered in this episode, we recommend seeking professional advice tailored to your individual situation.
Welcome back to Expert Money Matters. I'm your host, Georgina. At Chase Buchanan, we monitor global market shifts to turn uncertainty into opportunity. To provide you with total clarity, we've transformed our weekly market update email into this convenient audio format. Whether you're commuting or relaxing, stay informed on the move. Here is your update for February the 18th, 2026.
Good morning, or good afternoon, depending on where you are. Here at Chase Buchanan, we find ourselves reporting on yet another week of extraordinary internal market gyrations, and yet relatively modest movement at the index level. Remarkably, unlike January, very little of the action was precipitated by President Trump. Instead, it represented more of an expansion of the theme we discussed last week, namely the ongoing witch hunt for any sector that appears vulnerable to disruption by artificial intelligence. And one of the catalysts for last week's action was the launch of a tool claiming to be able to replace a substantial amount of the work and value provided by wealth managers and financial planners. This sent a number of UK investment platform names trading lower, with one in particular falling by double digits. Even so, there was a modicum of support for standalone wealth managers, thanks to a rather punchy multiple paid by one bank for a competitor. So perhaps we can take some comfort in the idea that there will still be demand for human financial advice in our increasingly robotic future. Although we will admit that may be a touch of wishful thinking on our part. Whereas the initial sell-off had previously been largely confined to software as a service companies within the software sector, last week the net spread considerably wider, encompassing real estate, logistics, brokers, and even elements of consumer discretionary and consumer staples. The broader concern is that jobs will be lost and that this will flow through to everything from business travel to catering. One might call these second-order effects rather than a specific and direct AI threat, but they still carry the potential to weigh meaningfully on activity. Reflecting on last year's market action, one of the key themes we observed was the remarkable speed at which investors can reevaluate companies. However, things can move just as swiftly in the other direction, and whilst broker responses suggest that some of the market movements we have witnessed are little more than a storm in a teacup, it does serve to illustrate the shoot first, ask questions later, nature of the market at the moment. As we noted last week, the issue is not so much the current profitability of a business under threat, but rather the potential collapse of future cash flows and what that therefore means for its terminal value. In the case of businesses that were perceived to have strong competitive moats and long runways for growth, that terminal value can represent a very substantial component of net present value indeed. That said, it is very easy to get caught up in all the negative headlines and to overlook the more positive aspects of the broader picture. Things like overall global economic and earnings growth, rising fiscal stimulus, and a benign policy rate environment. That environment received further support last week from a lower than expected inflation print in the United States. Even so, we are not complacent at Chase Buchanan, and we shall continue to keep a close eye on data such as US employment figures to assess whether there is a more meaningful threat to activity from AI-related job cuts. The results season continues to roll along in the background, and it is still going reasonably well in terms of the numbers being delivered. Almost 75% of US companies have now reported, and as if by coincidence, 75% of those have beaten on the bottom line. Markets today have been rather quiet, particularly with half-term upon us here in the United Kingdom and with the US closed for President's Day. As such, equities across the UK and Europe have closed broadly flat. Turning to the week ahead and closer to home, we have UK employment data due tomorrow. The headline: unemployment rate is forecast to remain unchanged at 5.1%. As usual, close attention will be paid to wage inflation, as this remains one of the key factors tying the Bank of England's hands when it comes to cutting rates. A small tick downward is expected, though public sector wage increases are still anticipated to be running above 5%. UK interest rate markets are currently pricing in 2 rate cuts this year, with the likelihood of one move coming as soon as April, although some voices in the market are calling for action even sooner than that.
And that wraps up this week's Market Snapshot. If you'd prefer to get the information before it's published here, you can sign up for the update directly on our website. Just visit chasebuchanan.com and subscribe and get the update delivered straight to your inbox, giving you a head start on the week. Thanks for listening to Expert Money Matters. I'm Georgina. Join us next time as we explore money matters for your life abroad.